Tesla's current P/E ratio sits at around 400. The S&P 500 average is 24. That means investors are paying roughly 17 times more for Tesla's earnings than the average company. The vehicles and parts industry median P/E ratio is just 19. Tesla's valuation is nearly 2,000% above its industry peers. So either Tesla is the most overvalued stock in history, or the market is pricing in something most people are not seeing yet. Today we find out which. Chapter 1. The car business. Let's start with what everyone knows. Tesla makes electric cars. And if you only look at the car business, the stock makes absolutely no sense at current prices. Vehicle deliveries were under pressure in 2025. Margins were squeezed by aggressive price cuts. Chinese competitors, BYD in particular, have closed the gap dramatically and now outsell Tesla in multiple markets. The car business alone cannot justify a P/E of 400. But here is the thing most people miss. The car is not the product. The car is the distribution vehicle for the real product. Every Tesla sold puts another data collection device on the road. Every mile driven trains the AI. And no competitor has anything close to Tesla's scale of real-world driving data. Tesla is no longer viewed merely as an automaker. It is a vertically integrated titan at the intersection of physical artificial intelligence, renewable energy, and autonomous mobility. Tesla's ecosystem lock-in strategy remains its primary competitive moat, decoupling its valuation from simple hardware delivery metrics. Chapter 2. The moat. So what actually protects Tesla from competition? Why can't Toyota, Waymo, or BYD simply copy what Tesla is doing? The answer is data, and specifically the scale of it. Tesla has accumulated billions of real-world driving miles across every road type, every weather condition, and every country on Earth. This data trains the AI that makes FSD and Robotaxi possible. Competitors cannot buy this data. They cannot replicate it quickly. Every day that passes Tesla's lead compounds. Add to that the supercharger network, the largest EV charging infrastructure in the world, now partially open to non-Tesla vehicles. The manufacturing expertise built over 15 years of vertical integration. And the brand, still the most recognized EV brand globally, despite recent political headwinds. These are real structural advantages. The question is whether they are worth a P/E of 400. That answer depends entirely on what comes next. Chapter 3. The Robotaxi Bet. This is where the P/E ratio either makes complete sense or looks completely insane. Tesla launched its Robotaxi service in June 2025 and has continued to expand the service, with unsupervised Robotaxi rides launched in Dallas and Houston in April 2026. The bull case is transformational. A fully autonomous ride-hailing network running on Tesla's existing fleet, no driver costs, software margins, vehicles generating revenue 24 hours a day. Morgan Stanley projects that Tesla will significantly increase its Robotaxi fleet this year, expanding from the current 50 to 150 vehicles to 1,000. If the autonomous driving technology works at scale, the economics are unlike anything in the automotive industry. You are not selling a car once. You are running a transportation network that generates recurring revenue indefinitely. Tesla Robotaxis currently face long wait times and service issues in Austin, Dallas, and Houston. The technology is harder than it looks. Regulators move slowly, and Elon Musk has both met and missed Tesla promises, and his autonomy goal remains unfulfilled. The narrative is shifting from fleet size to operational viability. In 2026, the focus should be on whether utilization rates, safety transparency, and cost structures begin to resemble a scalable business rather than a prolonged experiment. Chapter 4. Optimus and AI beyond Robotaxi. There is one more bet embedded in Tesla's valuation that makes the P/E ratio look almost conservative if it works. The Optimus humanoid robot. Tesla highlighted progress on Optimus ahead of mass production in its 2026 outlook, alongside the ramp of Robotaxi and continued progress on FSD. The thesis is straightforward. Tesla has built the world's most advanced real-world AI system for navigating physical environments, the same AI that drives the cars. A humanoid robot requires exactly that capability. Tesla's advantage is not the robot hardware. It is the AI trained on billions of real-world miles. If Optimus reaches mass production, the total addressable market dwarfs the automotive industry entirely. Every factory, every warehouse, every environment that currently requires human labor becomes a potential customer. Tesla is raising its 2026 AI infrastructure, spending to $25 billion, a signal of how seriously the company is investing in this future. Whether that investment generates returns is the central question. Chapter 5. Energy and other bets. A quick word on Tesla's other businesses, because they matter more than most coverage suggests. The energy division, Powerwall for homes, Megapack for grid-scale storage, is growing fast and carries higher margins than vehicles. Tesla reported record energy storage deployments in Q4 2025. As renewable energy grows globally, the need for battery storage grows with it. Tesla is one of very few companies with the manufacturing scale to meet that demand. The supercharger network, now partially open to competitors, is effectively a toll road on the electrification of transportation. And xAI, while separate from Tesla, represents another dimension of Musk's AI ecosystem that creates potential synergies with Tesla's own AI development. None of these alone justifies the current valuation. But together, they represent a portfolio of bets across the most important technological transitions of the next decade. Chapter 6. What if it does not work out? The bear case is equally compelling and significantly less speculative. Most analysts rate Tesla as significantly overvalued at current prices, with a fair value estimate of $285 and 10 warning signs investors should review. The car business is under genuine competitive pressure. Chinese manufacturers are building EVs at costs Tesla cannot match. Market share is eroding in Europe and Asia. Vehicle margins have been structurally compressed by years of price cuts. The Robotaxi promise has been delayed repeatedly. Full autonomy has been 1 year away since 2016. Every year it does not arrive the capital required to maintain. The promise increases. And there is the Elon Musk factor. His involvement in politics has demonstrably damaged the Tesla brand in key markets. His attention is divided between Tesla, SpaceX, xAI, and X. The company's future is deeply dependent on one person in a way that represents genuine concentration risk. At a PE of 400, there is essentially no margin for error. Any significant miss on Robotaxi, any deterioration in the energy business, any credible competitive threat to the AI moat, and the valuation has enormous room to compress. Tesla is not a stock you can analyze with a PE ratio alone. The question for investors in 2026 is not whether Tesla sells the most cars next month, but whether its lead in physical AI will allow it to own the future of autonomous movement over the next decade. At 400 times earnings, you are buying a vision. The vision is compelling, the execution risk is real, and the price already reflects enormous confidence in an outcome that has not yet been proven. Understand exactly what you are buying before you buy it. And if you want the complete framework for analyzing any stock, check out my complete investing masterclass. Link in the description.